Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today's question is something that most investors face if they decide to make the switch. My fund isn't performing well, so should I make the switch? And if I do that, will it break compounding? That's what we'll discuss today with our CEO, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So let's begin with, why do investors panic, first of all, when they see their fund underperforming for a few months also?
Because investing in a mutual fund and putting more so for a new investor is a very positive exercise. I invest to earn return.
Yeah.
And soon after I invest, it goes down in value. It falls. That's one. Second is that most new investors are used to fixed deposit, which only goes up, never comes down. It could be a surprise, even though whatever you may be, listening to the disclaimer that mutual funds, the value can go up and down and it could be volatile, or you may not get your principal back. Despite that, it's a positive endeavor, and so it's very natural for investors to get disappointed on the first decline in value of their principal.
But when is underperformance a warning sign? What tells you that a fund is struggling and not just going through a phase?
If the fund is unable to beat its benchmark, I will sell. If the fund stacks up at the bottom of the category, or consistently over 2 years period, every quarter, it's at the bottom, I will sell. I will be watchful if the fund manager is leaving. A fund manager brings in a whole new framework, new strategy. So I'll be watchful of that. So these two things will trigger my sell, and one thing will make me put it on my watch list again. And I will not be selling a fund soon after investing. One is I'll be choosing a fund based on careful assessment that it's beating its benchmark, it's a superior performer, it's a consistent performer. And once I have done that, I'll give it time.
Right. But the big fear is that if I switch, won't it break compounding?
Switching breaks compounding, but selling your poor performer is important because your compounding will be poor. Your compounding will be broken if you take your money out and consume it. If you take your money out and put it to work again, if you reinvest, your compounding won't be broken. There is always a barrier. The barrier is that you invested in a fund and it has gone up from, say, 10 rupees to 40 rupees, but it is not doing very well as compared to peers or not beating benchmark. You decide to sell and now you are sitting on 30 rupees gain. Yeah. And 30 rupee gain, taking that money out, reinvesting again will translate into a capital gains tax. Right. And that will reduce your capital. So that is why you should not change your fund hurriedly. And that is why you should be doing it carefully based on the assessment that this is a fund which is not worth holding any further. It's an important decision. It takes a small part of your money out of your compounding, but if it is important to get rid of it, pay the capital gains tax, move on.
So finally, if I have decided that I want to switch from a fund to another one, can you explain what exactly is the process of doing so?
Oh, the process is very straightforward. Redeem it, take the money out and invest again in the fund of your choice. Don't stagger it. Don't start doing a SIP. You accumulated the money by way of SIP. Yeah. And that is important for you to average your investments. Many a times that is a need, that is your cash flow. You are doing it from your monthly salary, but right. And it also helps in taking a measured exposure to the equity market, because most people panic once they invest lump sum. But as you are now used to equity, you have accumulated it in equity, taking that money out and investing in a fund of your choice, which you think will be a better performer, will be a superior performer than the one which you are redeeming. It's as simple as this. Okay. Redeem and sell, invest again.
So before we wrap up, last two things. One, what is the biggest behavioral mistake that people tend to make while deciding to switch? And secondly, if there is a checklist that they can go through before making the switch.
The mistake that starts the problem, that investors get very disappointed, is that they're chasing performance. Something has done exceedingly well and you invest. Every segment of the market is cyclical. And something which is doing exceptionally well, which attracts you, and that is the driver of your decision to invest, that is a bad choice. because generally it is disappointing. It stops doing well soon after you start investing, or maybe a little later. And if you continue doing this, you will be in a perpetual, you will be in a situation where you'll have to do this often. Choose your fund carefully. Choose the right kind of fund and sell a fund if you have it is not beating its benchmark and not beating its peers, or not good among peers of the option that you have, for at least 2 years. Give it this much time, until that time, and the finest of fund will have a lean patch. Sometimes the finest of fund you might have and the market is not doing well. Carry on. Investing through the lean times is very important, because that is what enhances your return.
All right, so switching is not about timing, it's about patience, discipline, and understanding if the fund has really lost the case and you need to make the switch. Well, that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.